In 1929, you could walk into a bank, take your money, and vanish into the storm. In 2026, you'll still see your balance, but the exits will already be sealed. The screens will glow, the numbers will move, and yet your savings will stay frozen in place. Because what's coming isn't just another crash. It's a trap built over nearly a century. In late October 1929, as the Dow Jones plunged almost 25% in just 2 trading days, Americans lined up at teller windows. They withdrew cash, emptied accounts, and hid paper bills under floorboards. The system was physical, slow, visible, human. You could touch your wealth. In March 2023, when Silicon Valley Bank collapsed, depositors watched helplessly as withdrawal requests were halted within hours. And today, over $7 trillion sit in tax-locked retirement accounts accessible only with penalties, processing delays, or government intervention. That's the hidden evolution. A system that no longer fears bank runs because it quietly removed your ability to run. Liquidity is an illusion, engineered by speed and software. Every protection, every stability mechanism is a wall disguised as safety. What once was freedom cash in hand is now a data entry bound by rules, gatekeeping, and code. They told us the modern system was unbreakable. That after 1929 and 2008, reforms made finance safer. But safer for whom? When crises hit, the same pattern repeats. The wealthy escape first, while ordinary savers are told to stay calm because they can't leave anymore. To understand why your money is no longer yours to move, we need to go back in time. Back to the moment when the idea of saving was replaced by the machinery of control. The year was 1928. Wall Street pulsed with euphoria. Ordinary Americans, taxi drivers, teachers opened brokerage accounts for the first time. Credit was easy. Margin loans borrowed money to buy stocks fueled a frenzy. By September 1929, margin debt had reached $8.5 billion, equal to nearly 10% of U.S. GDP at the time. The entire nation was betting on the same dream, that prices only go up. The system was simple, visible, human. Bank tellers handled paper passbooks. Traders held physical stock certificates. Wealth meant something you could hold. But beneath the optimism, cracks were forming. The Federal Reserve, created just 16 years earlier, was tightening credit to curb speculation. Brokers extended loans anyway. In the shadows, a few insiders' names like Joseph P. Kennedy and Bernard Baruch began to sell quietly, sensing the floor would give way. Then came Black Thursday, October 24, 1929. Panic struck. Crowds filled Broad Street as the ticker tape lagged hours behind the market. Within 5 days, $30 billion in market value vanished an entire year's worth of U.S. production. But unlike today, those who moved fast could still withdraw cash, sell certificates, and flee with tangible wealth. You could touch your loss, but at least you could leave. Banks failed, yet the exits remained open. Depositors lined up, and some walked away with their life savings in envelopes. It was brutal, but real. No digital locks, no transaction holds, no algorithmic suspensions. The world that followed changed everything. The panic exposed the system's weakness. It could bleed liquidity until nothing was left. So the response was not just to stabilize markets, it was to build a structure that could never again allow such freedom of flight. After the crash, America wanted safety, and Washington delivered it. In 1933, Franklin D. Roosevelt signed the Emergency Banking Act. For the first time in history, the U.S. government could close every bank in the nation overnight. It was called a bank holiday, but for millions, it was the first time they realized access to money could be revoked by decree. Then came the Glass-Steagall Act and the creation of the FDIC. On paper, these were shields against panic, but in practice, they shifted power from depositors to the state. You no longer had to run to the bank because the system could simply freeze time for you. And the next year, 1934, the Gold Reserve Act sealed the vault. Americans were forbidden to own monetary gold, forced to trade it for paper dollars at $35 per ounce. Overnight, the idea of independent wealth, the ability to exit the system, was outlawed. The decades that followed built walls higher. In 1971, Richard Nixon ended the gold standard entirely, severing money from any anchor of real value. In 2008, when the global financial system nearly imploded, the Federal Reserve printed over $700 billion in emergency liquidity to rescue banks, while depositors got reassurances and a new generation learned that liquidity was whatever the system allowed it to be. Fast forward to March 2020. Markets froze as pandemic panic hit. Mutual funds imposed gates. Some money market funds halted withdrawals. Ordinary people watched cash equivalents become unavailable overnight. In March 2023, the collapse of Silicon Valley Bank showed how modern panic unfolds at the speed of code. $42 billion withdrawn in 10 hours. Then silence. Digital doors locked. The pattern is ancient but perfected. Each crisis triggers reform. Each reform builds another lock. The story we're told is that these measures protect stability. But behind that language lies a darker truth, the architecture of containment. Here's the secret no one tells you. The modern financial system doesn't prevent collapse. It manages obedience during collapse. The true innovation of post-2008 finance isn't stability, it's control. Take your savings. That balance in your app isn't money. It's a claim on a liability that can be frozen, delayed, or revalued at will. When you click Withdraw, your request travels through a labyrinth. Custodians, clearinghouses, compliance gates, all of which have the power to say no. The tools of control are everywhere. The Dodd-Frank Act of 2010 legalized bail-ins, allowing banks to convert your deposits into capital during a crisis. The money market reform of 2014 gave funds the right to impose liquidity fees or redemption gates. Retirement accounts holding over $7 trillion in locked capital can't be liquidated instantly without tax or penalty. In 2020, funds like the BlackRock iShares corporate bond ETF briefly traded at steep discounts, while the Federal Reserve stepped in as a direct buyer to restore order. Order, not freedom, is now the prime objective. The deeper mechanism is technological. Algorithms now regulate risk exposure automatically. Clearing systems can halt settlements in microseconds. Digital compliance monitors every transfer for suspicious activity. Each rule was designed for safety, but together they form a perfect trap, a financial network that can lock itself the moment panic begins. And it's not just banks. Payment platforms, brokerages, even crypto exchanges all operate on permissioned systems. You don't hold your assets, you hold access rights revocable by policy or panic. In 1929, money was physical inertia. In 2026, it's digital obedience. The system learned that control, not confidence, is the real defense against collapse. Every reform, after every crisis, made sure of it. What began as protection from chaos has become the architecture of containment. The year is 2026. The warning lights are already flashing, slowing global growth. Record household debt, fragile banks, stuffed with government bonds that fall in value as rates rise. But this time, when the panic comes, you won't see crowds outside the banks. You'll see silence. Apps won't load. Transfers will time out. Your savings will still appear on the screen, but you won't be able to move them. That's not a glitch. It's the system doing exactly what it was designed to do. After nearly a century of reforms, your money lives inside a fortress you can't leave without permission. In 1929, people lost fortunes, but they could still hold gold, cash, or property in hand. In 2026, value exists as a digital promise, and that promise depends entirely on a network that serves the system first and the saver last. Look closely, and the signs are already here. Central banks are testing digital currencies with built-in traceability. Pension funds are struggling to meet obligations, unable to liquidate assets without triggering losses. Retail investors who thought they owned stocks through apps or ETFs are discovering they hold beneficial interests, not shares. Even so-called safe cash sits inside institutions that can legally freeze it in systemic emergencies. Every cycle repeats the same cruel symmetry. First freedom, then leverage, then control. 1929 built the locks. 2008 added the digital keys. 2026 may be the moment they're all used at once. And when that moment comes, the question won't be how much you have, it'll be whether you can touch it at all. History doesn't just rhyme. It consolidates. The same story plays out with sharper edges each time, until there's no escape left to study.